when you think of a 170-year-old financial company, you usually picture this massive, slow-moving ship, right?
Oh, yeah, completely. Like peak predictability.
Exactly. You look at their financial statements, and it's honestly like reading the manual for a grandfather clock. It's just, tick-tock, steady dividends, predictable single-digit growth.
Right. You expect them to just keep doing the exact same thing they've always done for, well, forever.
Yeah. But then you open up Western Union's first quarter 2026 earnings transcript, and suddenly that grandfather clock has just been ripped apart.
Yeah, violently ripped apart.
And somebody is like desperately trying to shove this AI-powered crypto engine into the old wooden casing. It's messy, it's incredibly loud, and looking at the numbers, I mean, wow, it is costing them an absolute fortune.
A literal fortune, yeah.
So when a company that is globally synonymous with, old school cash wires and those yellow storefront signs suddenly pivots to artificial intelligence, blockchain settlement, and aggressive global M&A, you really have to ask yourself, is this a visionary evolution, or is it just a desperate Hail Mary?
It's the ultimate question for anyone looking at the stock right now.
Right. And today, we are dissecting their Q1 earnings to find out. We're doing a deep dive, stripping away all that corporate jargon from the ticker symbol WU transcript to give you a fast, data-forward, and totally actionable breakdown.
Because that's what we do here.
Exactly. The goal here is simple. By the time we finish unpacking the real story behind these numbers, you will know exactly whether this wild corporate pivot is a reason for you to buy into the stock or just bail out immediately.
And, well, to get to that verdict, we really have to start with the raw headline numbers, right?
We do, yeah. Lay it on us.
Okay, so for anyone currently holding this stock, the immediate data is it's a pretty severe stumble right out of the gate. Let's look at the top line first.
Revenue.
Right. JEP revenue came in at $983 million for the first quarter. Now, for those, tracking the strict accounting terms, JAP simply stands for Generally Accepted Accounting Principles.
Right. It's the standard, unfiltered way the government makes them report the income.
Exactly. But Wall Street always looks at the adjusted numbers, right? Where management strips out those one-time costs to show the underlying business performance. So on an adjusted basis, that $983 million represents a 1% decline year over year.
A 1% drop, which, management tried to spin that, didn't they?
Oh, they were super quick to frame this as a positive. They pointed out that, hey, this is a 400 basis point improvement from the fourth quarter of last year.
And just to translate, in Wall Street speak, 400 basis points just means 4%.
Right. So the volume of revenue is still shrinking, but the rate of that shrinking has slowed down by 4% compared to the winter.
It's shrinking a little bit slower.
Yeah, exactly. They're basically pointing to this as a sign of relative stabilization.
Okay, but look, the top line shrinking by 1% is honestly only half the story. And arguably, it's the less terrifying half.
Oh, absolutely.
A 1% dip is a scratch. But the real shocker, the number that actually moves markets, was on the bottom line. Adjusted earnings per share, or EPS.
Yeah, this is where it gets brutal.
Right, because EPS is the actual profit divided up among all the outstanding shares. It's the ultimate measure of what you, the retail investor, actually get for owning a piece of this business.
Yeah.
So in Q1 of last year, Western Union delivered 41 cents per share. This quarter, it cratered to 25 cents.
Yeah, from 41 down to 25.
That is a massive, precipitous drop, and it significantly missed Wall Street's expectations.
By a mile. And the primary culprit for that total earnings wipeout is the adjusted operating margin. It dropped to a shockingly low 13%.
13%. Let that sink in. When your margin drops to 13%, it basically means for every $100 flowing through that iconic yellow logo, the company's only keeping $13.
Right.
And that $13 has to cover taxes, interest, and eventually whatever is left gets handed back to you, the shareholder.
It fundamentally alters the whole investment thesis. A margin that low forces us to ask if we are looking at a temporary, quarter-specific issue, or is this a structural, long-term degradation of their entire business model?
Yeah, because when you're operating a business with the massive global physical footprint that Western Union has, you totally rely on economies of scale.
Exactly. High margins act as a shock absorber for macroeconomic bumps in the road. And at 13%, that shock absorber is just gone.
They're feeling every single pothole.
Every single one. And management knows this. The CFO, Matt Cagwin, He spent a massive portion of the earnings call just trying to explain the why behind this margin compression.
Right. He was categorized the pain into like temporary timing issues versus structural shifts.
Yeah, he really tried to bucket them.
So let's unpack those temporary excuses first, because honestly, I have some serious questions about how they run their financial operations based on what he said.
Yeah, it was quite a list.
He listed this confluence of factors, starting with a lack of vendor incentive payments. Like apparently they got these payments in Q1 of last year, but this year they anticipate those payments arriving later in Q2, Q3, and Q4.
Right, creating a tough year-over-year comparison right out of the gate.
Exactly. And then they cited the cost of aggressive new agent signings.
Oh, yeah, the signing bonuses.
Yeah, they're paying upfront signing bonuses to secure these large retail partnerships. And so that hits the expense column today, but the revenue from those locations won't actually show up until way later in the year.
Right, so those are your classic timing mismatches. You pay the cash out now, but you don't reap the rewards until a later quarter.
Sure. Okay.
But the third excuse they gave is much more specific to a recent strategic shift. They cited severe seasonal weakness in their newly acquired travel money business.
Euro change.
Yeah, euro change. To understand this one, you really have to look at the mechanics of the foreign exchange kiosk business. So euro change was acquired to expand Western Union's travel money platform, essentially, providing physical foreign currency to travelers in the UK.
Right. But let me just jump in here. How does seasonality in a side business completely crush the margin of a massive global remittance company? I mean, people travel year-round, don't they?
Well, they do, but not in the volume required to cover the massive fixed costs. Think about it. The travel money business requires a heavy physical footprint.
Like physical booths.
Exactly. You need kiosks in airports, booths in train stations, storefronts in high-traffic tourist areas, and you have to pay the rent, the security, the employees for those physical locations every single day of the year.
Even when no one is flying.
Right. And in the first quarter, January, February, March, leisure travel out of the UK is naturally at its lowest point of the year.
That makes sense.
And then you compound that with recent geopolitical tensions in the Middle East, which significantly dampened European travel to popular winter sun destinations, places like Dubai.
Oh, interesting. So the volume just dried up.
Yeah, you have a severe volume problem. So Western Union is paying 100% of the fixed costs for those Eurochange locations in Q1, but the massive revenue surge from summer holidays doesn't actually materialize until Q2 and Q3.
So that mismatch acts as this massive anchor, just dragging the overall corporate margin down in the first 3 months of the year.
Precisely.
Okay, I can accept the seasonality argument for a physical travel kiosk. It takes time for the summer vacationers to show up. But the fourth excuse the CFO gave, that is the one that really sets off alarm bells for me.
Oh, the FX loss.
Yes. He cited a foreign currency remeasurement loss, an FX loss. Now, let us be incredibly clear about what Western Union does for a living.
Right, they move money.
They are a global money transfer company. Moving money across borders and navigating foreign exchange rates is literally their core competency. It's the lifeblood of their 170-year-old business. So how does a company built entirely on mastering currency exchange get surprised by an FX loss that is large enough to shave multiple pennies off their earnings per share?
It is a glaring inconsistency. And honestly, the analysts on the call absolutely hammered them on it.
I bet they did.
To understand how this actually happens, you have to look at the plumbing of international finance. Western Union actively manages their FX risk constantly throughout the quarter, right? They use hedging instruments, forward contracts, massive liquidity pools.
Just to make sure they don't get caught out.
Exactly. To ensure that when someone hands them US dollars in Texas and someone picks up Mexican pesos in Monterrey, 10 minutes later, Western Union doesn't lose money if the exchange rate flickers in those 10 minutes.
Right, that's day-to-day operations.
Right. However, corporate accounting requires these point-in-time remeasurements. So when they close the books on the very last day of the quarter, in this case, late March, they have to value all the foreign currency sitting in their global bank accounts against the US dollar.
So if the currency markets just happen to swing wildly on the specific day they take that accounting snapshot, they take a paper loss, even if their actual day-to-day hedging is totally solid?
Precisely. That's exactly it. And the CFO defended this by noting that over the last 10 years, they have only had a few instances where an end-of-quarter currency fluctuation hit them this hard.
Is bad timing.
Yeah, he argued it's a remeasurement timing loss, not a failure of their core operational hedging. But look, the optics are terrible.
Oh, completely terrible.
It is not a comforting look for a business built on the premise of mastering currency exchange to cite an FX loss as a surprise drag on earnings.
No, especially when you are asking investors to trust you with a massive, highly complex corporate turnaround. You cannot afford unforced errors on the one thing you're supposed to be the absolute best in the world at doing.
Yeah, it really shakes the foundation of trust.
It does. And that brings us to, I think, the most critical phrase uttered on this entire earnings call. After listing the timing issues, the agent bonuses, the euro change seasonality, and that awkward FX surprise, management blamed a massive portion of the margin compression on what they called a dual-track dislocation.
The track dislocation.
I mean, that's peak corporate earnings call vocabulary right there. It sounds like a severe spinal injury you get from a roller coaster.
It really does.
So we need to strip the jargon away. What does a dual-track dislocation actually look like mechanically inside this company?
Okay, so it is the defining dilemma of the modern corporate age for legacy companies. Let's imagine Western Union as an enormous, heavy, older commercial airliner flying at 30,000 feet.
Okay, I'm picturing it.
Track 1 is their legacy business. The old, expensive physical infrastructure, the traditional agent networks, the older software mainframes that have been running the back end for decades.
The old engines.
Exactly. They're desperately trying to optimize this track, stripping weight out of the plane, trying to make those old jet engines burn less fuel. Now, track 2 is the future, the shiny new digital house. They are trying to build cloud-native applications, deploy artificial intelligence, and launch crypto networks.
So they're trying to change the engines on the airplane while it is in mid-flight.
Yep.
They are paying the massive fuel costs of keeping the old, inefficient jet engines running to keep the plane in the sky, while simultaneously spending billions of dollars to bolt brand new, unproven electric thrusters onto the wings.
That's a great way to put it.
And the aerodynamic drag from doing both at the exact same time is basically pulling them out of the sky.
That is the exact mechanical friction of a dual-track dislocation. You see, the original master plan presented to Wall Street was supposed to be this perfectly balanced equation. Western Union told investors, hey, we'll carefully fund the building of the new digital engines using the savings we ruthlessly extract from the old legacy engines.
Right, keeping it budget neutral.
Yeah. That way, the overall corporate profit margins stay perfectly stable, hovering around 20%, while the company slowly transforms in the background.
But this quarter, that delicate financial balance just broke.
It broke hard. It became dislocated. The cost of building the new tech, investing heavily in digital assets, launching new digital wallets globally, replacing core data platforms, massively outpaced the savings they were able to pull out of the legacy systems.
Wow.
They spent money significantly faster on the future than they could cut it from the past. And the difference between what they spent and what they saved is exactly why the margin plummeted to 13%.
So the earnings are just draining out of the bottom of the plane.
Exactly.
To figure out if they can pull out of this dive, we have to look at the actual performance of these two different engines. So let's start with the bad news, the old legacy engine. The core physical business, which management calls consumer money transfer, or CMT.
CMT, right.
Adjusted revenue for this core segment was down 6% in the quarter. Now, to understand why the legacy engine is stalling, we really have to look at the Americas, and specifically the U.S. to Mexico remittance corridor, because this is the largest single remittance pipeline on the planet.
By far.
And right now, it is under immense pressure.
Yeah, the CEO, Devin McGranahan, he dedicated a significant portion of his opening remarks to this specific corridor, and for good reason. It dictates the weather for the entire company.
Oh, cool.
He cited central bank data showing that 2025 was a distinctly down year for this massive route. At multiple points last summer, the monthly inbound principal, which, is the actual volume of hard cash crossing the border, declined by double digits.
Which is terrifying.
Yeah.
You really have to ask what macroeconomic forces are powerful enough to shrink the biggest money pipeline in the world like that.
Right. And management pointed to a combination of macroeconomic factors, specifically citing shifting migration dynamics and U.S. immigration policy uncertainty.
Okay. Now, from a purely data-driven investment perspective, completely setting aside the political noise surrounding the border, we just have to look at the economic behavior of the migrant worker.
Right. Keep it to the data.
If you are a worker sending a portion of your weekly paycheck back to your family in Mexico, Your behavior is entirely dictated by your confidence in your near-term future.
It is fundamental behavioral economics. When immigration policies are in flux, or when local labor markets like in construction, agriculture, or hospitality become uncertain, the behavior of the sender fundamentally changes.
Of course it does.
If a worker is suddenly unsure about their employment status for the next 3 months, or if they are concerned about their physical living situation due to policy shifts, they're going to stop sending discretionary cash across the border.
They transition into a defensive posture.
Exactly. They hoard their cash in the U.S. to build a personal safety net to weather the localized uncertainty. They only send the bare absolute minimum required for their family's immediate survival back home.
And honestly, it is entirely rational. If you think you might lose your job tomorrow, you do not wire your savings away today.
No, you don't.
But as an investor, you want to know if that defensive posture is permanent or if the U.S. to Mexico corridor is finally starting to thaw out. Did management offer any data to suggest the hoarding behavior is ending?
They actually did. They provided very specific data points indicating a stabilization phase. While the transaction growth rate for U.S. to Mexico is still technically negative, it improved by 350 basis points, that 3.5% improvement we mentioned earlier, relative to the fourth quarter.
Okay, so it's less negative.
Right. They are seeing inbound principal activity hovering around flat to low single digits now. That is a vast improvement from the terrifying double-digit drops they experienced last summer.
Oh, for sure.
Furthermore, they highlighted that other major Latin American corridors, like the U.S. to Ecuador and the U.S. to Guatemala, are actually showing meaningful improvement, returning to growth.
Though, to be fair, they did admit that the U.S. to Colombia corridor is still showing significant weakness, which kind of proves this isn't a uniform recovery across the board.
No, it's definitely mixed.
But what is driving the stabilization in Mexico and Guatemala specifically?
Well, they attribute it to a normalization of migrant behavior. The initial shock of policy uncertainty has kind of passed, and workers are adjusting to the new baseline.
They're finding a new normal.
Yeah. But more importantly, management highlighted a fundamental economic reality of the global remittance market. For many of these receiving economies, remittances are entirely non-discretionary.
Meaning they absolutely have to have the money.
Yes. The money sent from the U.S. represents a massive foundational share of the local GDP in those countries. It pays for groceries, medical care, primary housing. You can delay sending money for a few months to build a safety net, but eventually, the family back home needs the capital to survive.
The money ultimately has to flow.
The money has to flow.
Okay, so the old legacy engine, the physical cash business, is still shrinking, but the rate of decline has slowed down. It is stabilizing. Now let us look at the brand new digital engine they are trying to build, the areas where they are actively finding growth. Because the consumer services division seems to be a major bright spot in the data.
Oh, it is the standout performer of the quarter. Consumer services adjusted revenue was up a staggering 33%.
33%.
Yeah. This division is, well, it's an amalgamation of smaller bets, heavily driven by growth in their consumer bill pay business in certain markets, but primarily propelled by that travel money business we talked about, Eurochange.
Wait, despite the severe Q1 seasonality drag on the profit margin?
Exactly. Despite the margin drag, the actual top-line revenue growth of that division is exclusive. Management told analysts that they expect the travel money business to approach a $150 million annual revenue run rate this year.
$150 million annual run rate for a travel money side hustle. I mean, that is incredibly impressive, especially considering it was generating basically zero revenue for them just a few years ago.
Yeah, it shows they can successfully execute an acquisition and scale it globally.
True, but a $150 million side business does not save a multi-billion-dollar legacy company.
No, it doesn't.
The growth area that management was really pounding the table on, the metric they wanted every analyst to focus on, was their branded digital business.
Right. They reported that digital transactions spiked by an impressive 21% in the quarter.
21%.
Yeah, and that marks the 10th consecutive quarter of solid volume growth for their digital segment. It's a really clear indicator that their newer mobile apps and online platforms are successfully attracting users.
And a 21% spike in digital transactions sounds fantastic on the surface.
On the surface, yes.
But this is exactly where you have to peel back the layers of the earnings transcript, because this is where the story gets deeply, deeply concerning for the retail investor. Yes, the volume of digital transactions was up 21%. But if you look just one line further down the balance sheet, the actual digital revenue only grew by 6%.
Yep. There it is.
You have a massive 15-point gap between the sheer volume of transactions you are processing and the actual money you're making off of them.
It is the most glaring discrepancy in the entire financial report, honestly, and it raises a critically important question about the quality, profitability, and sustainability of that digital growth. I mean, if you are doing 21% more work but only getting paid 6% more money, your business model has a structural leak.
Exactly. When I see numbers like that, it looks like they are buying market share at the dollar store.
Buying market share, yeah.
Like, if you have to aggressively slash your prices and practically give away the product just to get people to download your digital app instead of a competitor's, is that 21% transaction growth actually a sustainable victory? Or is it just a temporary sugar rush fueled by venture capital style customer acquisition costs?
Right, because if the moment you stop offering free transfers, the customers immediately leave, you haven't built a business, you've just built a very expensive habit.
Exactly. So how did they explain this?
Well, that tension was the focal point of the Q&A portion of the call. The Wall Street analysts pressed the executive team hard on this exact issue, and management did not hide from it. They acknowledged that the revenue growth gap has increased significantly.
At least they owned it.
Yeah. And to their credit, they provided a very detailed three-part structural explanation for why revenue is lagging so far behind transaction volume. First, they were seeing massive growth in what they call lower RPT revenue per transaction corridors.
Break down the mechanics of RPT for us. Why are some global routes fundamentally cheaper than others?
It really comes down to market maturity and local competition. Historically, Western Union made incredibly high margins on the U.S. to Latin America routes because they had this massive physical infrastructure that no one else could match.
Right, the moat.
Exactly, the moat. But in the digital age, they are expanding heavily into places like India and signing new mobile wallet partnerships in the Middle East, and the digital infrastructure in India, for example, with their UPI system.
Oh, yeah, the UPI is everywhere there.
It is highly advanced and highly commoditized, so the fees Western Union can competitively charge on a digital transfer to India are structurally much, much lower than their historical averages in the Americas.
Because everyone else can do it just as easily.
Right. They're doing significantly more total business, moving larger overall volumes of money, but they are doing it in cheaper, lower margin neighborhoods.
So factor one is the geographic shift toward lower margin countries. What is the second reason for the revenue lag?
The rapid explosion of a specific product. Payout to account. Traditionally, Western Union's most profitable transaction happens when a sender walks into a physical store in Chicago, hands over physical cash, and the receiver walks into a physical store in Manila and picks up physical cash.
Cash to cash.
Right. Western Union charges a premium margin for managing the logistics, the security, and the physical availability of that paper money. But right now, their fastest growing segment globally is people sending money directly from the Western Union mobile app straight into a receiver's local bank account.
Yeah, account payout transactions grew by over 45% this quarter. That is the strongest quarterly growth they have seen for that specific product in 4 years. It is obviously what the consumer wants.
Of course. The friction is significantly lower, and the convenience is infinitely higher for the user. They don't have to leave their house. But the margin Western Union can justify charging is significantly lower than a cash pickup.
Because Western Union doesn't have to pay a local agent a commission to hand over physical cash, so the underlying cost of the transaction drops. But more importantly, the consumer knows that a digital transfer is cheaper than a physical cash transfer. The consumer refuses to pay a high fee for a digital routing number update. Western Union is forced to pass the savings on to the consumer just to remain competitive with purely digital rivals like Remitly or Wise.
Yeah, they have to.
So they lose the premium cash margin, replacing it with a lower margin digital volume business.
Precisely. The shift from physical cash to digital account payout inherently compresses the revenue per transaction, but it was the third factor that directly validates your dollar store analogy.
Oh, really?
Yeah. The CEO frankly admitted that coming out of the depressed volume lows of the U.S. to Mexico corridor last summer, they made a strategic decision to follow aggressive market trends toward new customer promotional pricing.
They literally bought the growth.
Yes, they did. They deliberately suppressed their own short-term revenue and slashed their take rate to acquire those customers. They offered zero-fee first transfers, highly subsidized exchange rates, aggressive marketing bounties. They recognize that the digital remittance space is a land grab right now. If a customer links their primary bank account to your app, they are highly likely to stick around for future transfers due to sheer inertia.
Because it's a hassle to set it up again somewhere else.
Exactly. So Western Union is willing to take a loss on the first few transactions to acquire the lifetime value of that digital user. Management stated they believe they can slowly ease off those promotional throttles and improve the pricing dynamics in the coming quarters. But for now, accepting a massive hit to revenue growth is simply the cost of doing business in a hyper-competitive digital landscape.
Okay, so if we synthesize the entire story behind the Q1 numbers, the picture becomes incredibly clear.
Very clear.
The massive, highly profitable legacy cash business in the Americas is shrinking due to macroeconomic uncertainty. The brand new digital business is growing extremely fast, but it is structurally far less profitable right now because they are expanding into cheaper countries, shifting away from high-margin cash payouts and spending a fortune on promotional pricing to buy new users. The attempt to manage the financial friction between this shrinking legacy business and this expensive new digital business resulted in a brutal dual-track dislocation. The costs outran the savings, their operating margins got crushed down to 13%, and their earnings per share effectively got cut in half.
It's a tough spot to be in.
That is a sobering reality check for anyone holding this stock. It paints a picture of a company in the middle of a very painful, very expensive metamorphosis.
Which brings us to the most fascinating part of the earnings call, management guidance.
Yes.
Because despite laying out all of this very visible, very painful first quarter data, Western Union's executive team came out and did something genuinely surprising.
They held the line. They completely reaffirmed their full year 2026 outlook.
Incredible.
Despite the severe Q1 earnings miss, they are still promising Wall Street that they will deliver between 6% and 9% adjusted revenue growth for the entire year and an adjusted EPS between $1.75 and $1.85. That guidance is just staggering when you look at the math. I mean, the CFO explicitly stated during the call that they expect the upcoming second quarter Q2 earnings per share to look very similar to last year.
Yeah.
They're not expecting a miraculous recovery tomorrow.
Well, Q2 is going to be flat.
So if Q1 was a massive disaster and Q2 is modeled to be essentially flat, the only mathematical way they hit those lofty full-year targets of $1.85 per share is if they rely on an absolute explosion of profitability in the third and fourth quarters.
Yep.
We are talking about a company banking its entire fiscal year on a massive vertical back half hockey stick recovery.
And let me tell you, the hockey stick projection is universally terrifying for investors. It means all the promised good news is backloaded into the final months of the year, leaving absolutely zero margin for error.
Zero.
If execution slips by even a few weeks, the entire year is a failure.
So how on earth is management projecting they will pull off this miraculous back half recovery? What are the specific levers they are promising to pull?
Okay, so they laid out a very aggressive, highly complex roadmap of catalysts that all have to hit perfectly and simultaneously in the back half of the year. Okay. The first massive catalyst is a severe, rapid acceleration of their cost-cutting initiatives. In direct response to this Q1 margin stumble, they are hitting the gas on a massive $150 million operational efficiency program.
$150 million.
Right, and originally this was supposed to be a longer-term structural realignment stretching all the way out to 2028. But the Q1 pain forced their hand. They are now aggressively pulling large chunks of those intended savings forward into late 2026 and early 2027.
But wait, how do you just magically accelerate $150 million in savings? You can't just flip a switch and make expenses disappear. Where is the actual physical money coming from? What are they cutting?
Well, the harsh reality of corporate efficiency programs is that the vast majority of that $150 million is coming directly from human headcount reduction. Yeah. And they are achieving this reduction through two primary mechanisms: artificial intelligence and aggressive geographic restructuring.
Okay, AI and offshoring.
The CEO was incredibly explicit about how they are leveraging AI to completely rationalize their existing business processes.
Let's dig into the mechanics of that, actually. Because rationalizing business processes with AI is a great buzzword, right? It sounds great on a slide. But what does it actually mean for a money transfer company? How does an AI program replace a human worker at Western Union?
It happens across the entire middle and back office. Take customer service, for example. Historically, if a transaction is flagged for a minor compliance issue, say a name mismatch on a bank account. A human agent in a call center has to manually review the file, check the database, and contact the sender.
Takes time and money.
Exactly. Western Union is deploying AI models that can instantaneously review those flags, cross-reference global compliance databases, and automatically clear low-risk transactions without a single human touch. And it's not just customer service. In software development, they're using AI coding assistants to drastically reduce the time it takes to build and test new features for their mobile app. Even in marketing, AI is being used to automatically generate localized promotional campaigns for dozens of different countries.
So the AI tools are basically drastically increasing the output per employee.
Exactly. And the CEO bluntly stated the ultimate outcome of this increased efficiency. As these AI tools automate the workflow and replace the need for manual labor, Western Union is simply stopping all backfill hiring.
Attrition.
Right. When an employee leaves or when a team is restructured, they do not hire a replacement. They replace the human labor with software at an accelerated pace. They are systematically shrinking the total size of their global workforce.
So what about the geographic restructuring?
This is the second half of the efficiency program. They are systematically tearing down their expensive, centralized corporate overhead. As part of what they call their internal beyond strategy, they are regionalizing their core operations.
Meaning moving them out of expensive cities.
Yes. For example, they announced they are moving massive amounts of their global operational support to a new primary center in Manila for the Asia-Pacific region. Moving thousands of back-office jobs from legacy corporate centers in North America or Europe to the Philippines obviously carries a significantly structurally lower cost profile.
Okay, so the first pillar of the hockey stick recovery is rapidly shrinking the workforce by replacing people with AI software and moving the remaining jobs to offshore centers like Manila. Got it. What is the second major catalyst they're banking on?
M&A synergies, mergers and acquisitions.
The buying spree.
Western Union has been on an absolute global buying spree over the last 12 months, and they are now completely relying on the financial benefits of those purchases to kick in immediately and save the back half of the year.
Right.
And the biggest and most critical piece of this puzzle is the delayed acquisition of Intermex.
Now, Intermex is a massive player in the U.S. to Latin America remittance market. Getting regulatory approval to buy a direct competitor usually takes forever.
It does, which is why it was delayed, but management stated the deal is finally expected to close in the second quarter.
Okay.
The acquisition of Intermex is crucial for Western Union's top line because it immediately bolsters their U.S. retail presence by adding roughly 10,000 new active agent locations that have deep established roots in the highly lucrative Latin American remittance corridors.
10,000 locations is a huge footprint bump.
It is. But more importantly, for the hockey stick recovery, it is about the bottom line cost saving.
Right, the famous corporate synergies. Explain how merging two massive companies actually creates cost savings rather than just doubling the expenses.
Well, when Western Union buys Intermex, they aren't just buying the 10,000 retail locations. They're buying the entire corporate structure of Intermex. They are inheriting Intermex's HR department, their legal team, their IT infrastructure, their compliance officers.
They get everything.
Right. And synergy is the brutal process of eliminating the overlap. Western Union doesn't need two separate legal departments to run the combined company. They don't need two separate HR platforms.
So they fire the redundant staff.
Basically, yeah. They integrate the Intermex agents onto the Western Union backend, and then they eliminate the redundant Intermex corporate overhead. Management had previously promised Wall Street that they would extract $30 million in cost synergies from combining the two companies over a 2-year period.
$30 million.
Yes. But on this specific earnings call, the CEO stated he is now highly optimistic that they can heavily front-load a massive portion of those $30 million in savings into the third and fourth quarters of this year.
Wow, they are desperately pulling every lever to hit that $1.85 EPS target.
Yeah.
And Intermex isn't the only acquisition they're relying on, right? They have been buying companies all over the globe to fundamentally alter how money moves through their system.
Exactly. They recently closed on the acquisition of a company called Lana in Mexico and another called Dash in Singapore.
Okay, Lana and Dash.
And the underlying strategy behind these specific acquisitions is vital for any investor to understand because it represents a massive shift in Western Union's historical business model.
How so?
Well, historically, Western Union only worried about the send side of the equation. They focused on capturing the customer who was standing in a U.S. strip mall with cash. They didn't really care where the money landed as long as it got there. Now they are fiercely focused on owning the receive side of the global transaction.
Interesting. Why the sudden focus on the receiver?
Because that is where the margin is bleeding out. Lana gives Western Union the regulatory license and the technical foundation to launch their own proprietary digital wallet in Mexico. Dash is an established digital wallet business that was previously owned by Singtel.
Okay.
The ultimate strategic goal is to create a closed-loop financial system. When a construction worker in Texas sends a portion of his paycheck to his family in Mexico, Western Union desperately wants that money to land directly inside a Western Union-owned digital wallet on the receiver's phone.
Rather than being routed out to a third-party local Mexican bank or picked up as cash at a local grocery store. Because if it lands in their own proprietary wallet ecosystem, they don't have to pay a toll to anyone else. It is the Apple Pay model. Yeah. Keep the user entirely inside the walled garden.
Precisely. If the money stays inside the Western Union ecosystem, it entirely eliminates the commission expense they currently have to pay to local payout partners or correspondent banks. That instantly and drastically improves the profit margin on every single cross-border transaction.
That makes total sense.
But the strategy goes even deeper than transaction margins. If the receiving customer in Mexico keeps the money inside that Western Union digital wallet to pay their local utility bills, or uses a linked debit card to buy groceries at the market, it opens up entirely new, incredibly sticky revenue streams for Western Union.
Oh, because they become the bank.
Right. They transition from being a one-off transactional pipeline to becoming the primary, everyday financial operating system for that global family.
It is a brilliant long-term strategy, honestly. Build the closed-loop global financial ecosystem through these targeted international acquisitions. So we have AI cost-cutting, tearing down the legacy overhead, and we have M&A synergies building up the new digital walled garden.
Right.
But then we get to the third major catalyst for the back half of the year. And I have to admit, when I was reading the earnings transcript, this is the section where I nearly fell out of my chair.
Oh, I know what you're talking about.
It is the crypto wildcard.
It is arguably the most fascinating, the most unexpected, and the riskiest part of their entire forward-looking guidance.
It's wild.
The CEO bluntly declared to the analysts that the company has crossed an important internal threshold. It is no longer a question of if Western Union will be an active participant in digital assets and blockchain technology.
They're all in.
Yes. It is now solely a question of how fast they can scale their operations. They are rolling out a massive, highly complex, three-pronged crypto strategy right now, and they expect it to contribute to the efficiency of the back half of the year.
Okay, you have to break down these three prongs for me in detail, because this sounds like a massive, almost incomprehensible departure for a company whose core brand identity for over a century is literally a physical yellow piece of paper that you fill out with a ballpoint pen.
Yeah, it's a huge shift.
How does a company that built its empire on telegraphs and physical cash suddenly pivot to blockchain?
It requires a fundamental rewiring of their infrastructure. Let's start with prong one, USDPT.
Okay, USDPT.
This is Western Union's proprietary US dollar-backed stablecoin. Management announced that it is in the absolute final stages of technical readiness and actually goes live in a production environment next month.
Wow, next month.
However, it is crucial to understand that this initial stablecoin launch is not a product for everyday consumers. It is strictly a tool for internal B2B treasury operations.
Okay.
Western Union is going to use their own proprietary stablecoin to settle funds globally with their massive network of retail agents directly on the blockchain, bypassing the traditional banking system entirely.
Okay, stop right there. I need you to explain the mechanics of this because I know exactly what the listener is thinking right now. Why on earth would a massive corporation go through the immense regulatory and technical hassle of building a bespoke cryptocurrency just to pay its own retail partners? What is broken about the normal banking system?
What is broken is the speed and capital inefficiency of legacy correspondent banking. Let's look at the traditional SWIFT system that global banks use.
The standard wire system, right?
Look, if a Western Union agent in the Philippines pays out a massive volume of cash to receivers on a Friday evening, Western Union corporate in the United States needs to replenish that agent's bank account so they can open for business on Saturday.
Makes sense.
But under the traditional banking system, the U.S. bank has to send a messaging wire to a correspondent bank, which then routes it to the local Philippine bank. Because traditional banks are closed on weekends and holidays, that settlement wire will not actually clear and finalize until Tuesday morning.
Ah, So there is a multi-day trust gap where the money is just floating in the ether.
Exactly. And to bridge that gap, to ensure that the agent in the Philippines doesn't physically run out of cash over the weekend, Western Union has to park hundreds of millions of dollars of its own corporate cash in localized Nostro and Vostro accounts around the world.
Nostro and Vostro, right.
It is called trapped working capital.
Yeah.
It is money that does absolutely nothing except sit in local banks to guarantee liquidity over the weekends.
It's just dead money.
Yes. Blockchain technology completely eliminates that friction. A stablecoin transaction settles natively, instantly, 24 hours a day, 7 days a week, 365 days a year.
Wow.
By moving their internal cross-border settlements onto the blockchain, Western Union instantly frees up massive amounts of that trapped working capital. They don't have to pre-fund foreign bank accounts anymore because they can instantly settle with the agent on a Saturday night in 3 seconds.
That's huge.
It is a massive structural, operational efficiency play that fundamentally lowers their cost of capital.
Okay. When you explain the mechanics of trapped working capital over a weekend, I can actually see the brilliant logic in using a stablecoin to fix their back office plumbing. It makes the engine run smoother. But what about the consumer-facing side of crypto? How does the everyday person interact with this?
That leads directly to prong 2 of their strategy, the digital asset network, or DAN. This is where the pivot gets truly wild. The CEO announced they're launching their first major external partner on this network next week. The DAN ecosystem essentially turns Western Union's vast physical global retail footprint into a massive cash-out register for the entire cryptocurrency industry.
Again, I have to vocalize the immediate skepticism of our listener here. I know what you're thinking right now. If the entire ideological point of cryptocurrency is to have a bankless, frictionless, purely digital asset, why on earth would a crypto bro need a physical Western Union location? Why would someone holding Bitcoin on their phone walk into a strip mall to get physical paper cash?
Because it is the ultimate paradox of the current crypto ecosystem. The digital technology is flawless, but the physical reality is messy.
Right.
Right now, there are tens of millions of people globally holding various digital assets in non-custodial crypto wallets. But one of the most difficult, expensive, and heavily regulated problems in the entire cryptocurrency industry is the off-ramp.
Getting the money out.
Yes. How do you safely and legally turn that digital token back into physical, localized fiat currency so you can pay your landlord or buy groceries at a market that doesn't accept Bitcoin?
Right, because my landlord definitely does not take Bitcoin.
Exactly. Historically, you had to route it through a centralized exchange like Coinbase, link a traditional bank account, wait days for the ACH transfer to clear, and pay hefty fees.
And a massive portion of the global unbanked population who use crypto simply don't have a traditional bank account to link to an exchange in the first place.
Exactly. The DAN network solves the off-ramp crisis by bridging the digital world directly into the physical world. Through this network, a user holding a stablecoin in a digital wallet will be able to initiate a transaction on their phone, instantly convert their digital assets into the local fiat currency, and walk into any participating local Western Union agent to pick up the cold hard cash in minutes.
Wow. So Western Union is creating an entirely new, highly lucrative distribution channel that brings native digital asset users directly into their physical retail locations. They are monetizing the crypto industry's biggest bottleneck.
They absolutely are.
Monetizing the off-ramp is a massive opportunity if, and that is a big if, they can navigate the regulatory nightmare of anti-money laundering compliance.
Yeah, compliance is the huge hurdle there.
Which brings us to the final piece of the puzzle.
Yeah.
What is prong 3?
The launch of a consumer-facing US dollar stable card. They are rolling this out later this year in dozens of targeted international markets.
A stable card.
Yes. This specific product is designed for consumers in regions suffering from severe hyperinflation. Imagine a customer living in Argentina, where the local peso is rapidly losing purchasing power, or in Turkey, dealing with massive lira devaluation.
Right, their money is just vanishing.
Exactly. The Western Union stable card allows that consumer to instantly convert their local salary into a US dollar-denominated stablecoin. They hold their wealth in digital dollars to protect it from local inflation. Then, Western Union issues them a physical debit card linked directly to that stablecoin balance.
Oh, that's clever.
They can spend that digital dollar locally at the grocery store or globally wherever traditional card networks like Visa or MasterCard are accepted. The transaction converts the stablecoin back to the local currency at the exact moment of sale.
It effectively bridges the safety of the digital US dollar directly into everyday local commerce for millions of people trapped in failing local economies.
It is incredibly ambitious.
Ambitious is the polite word for it. I am going to play the hard skeptic here because I am looking at this entire massive roadmap for the second half of 2026, and the math just feels overwhelmingly improbable.
It's a lot to swallow.
Management is looking retail investors dead in the eye and saying that to hit their promised full-year guidance of $1.85 EPS, they just need to do a few minor things in the next 6 months.
Just a few minor things, yeah.
They just need to seamlessly integrate a massive 10,000 location U.S. acquisition in Intermex and immediately fire all the redundant staff. They need to launch a global, blockchain-based B2B stablecoin settlement network to rewire their corporate treasury. They need to successfully turn thousands of physical stores into a crypto cash-out register without running afoul of global financial regulators.
Right.
They need to roll out proprietary consumer digital wallets in Mexico and Singapore to build a walled garden. And, oh yeah, as a side project, they need to deploy artificial intelligence to overhaul their entire global workforce, offshore thousands of jobs to Manila, and extract $150 million in hard costs.
When you list it out sequentially like that, the sheer density of the transformation is staggering.
It is not just staggering, it feels like the ultimate desperate Hail Mary pass.
Yeah.
They're taking every single hot buzzword that Wall Street currently loves, AI, crypto off-ramps, M&A synergies, blockchain settlement, digital wallets, and they're throwing them all at the wall simultaneously to distract from the brutal reality that their core U.S. cash remittance business is shrinking and their operating margins just got crushed to a historic low of 13%.
That's certainly one way to read it.
I have to ask you, looking at corporate history, can any 170-year-old legacy company realistically execute on this level of simultaneous, highly complex, multi-continental transformation in just 2 quarters without dropping the ball?
Well, the blunt answer is that the historical odds are heavily stacked against them. The friction of executing just one of these initiatives usually causes a legacy company to stumble. Attempting to execute all of them simultaneously is exactly why this is such a polarizing stock right now. That exact execution risk is what every single institutional investor is intensely weighing.
I would hope so.
Now, to be entirely fair to Western Union's management team, the CEO aggressively pushed back against this skepticism on the call.
I'm sure he did.
He pointed out, with data, that they have successfully executed on a prior $150 million cost-saving program ahead of schedule. He pointed to the fact that they successfully built the Eurochange travel money business from scratch into a $150 million run rate division. He explicitly called large-scale operational restructuring a known muscle and skill for the executive team.
So they believe they can do it.
They strongly believe they have the right pilots in the cockpit to change the engines mid-flight.
But having done it before doesn't change the physics of the current dive.
No, it does not. The margin for error in the third and fourth quarters is practically zero. If the Intermex IT integration hits a snag and the synergies are delayed by even a few months, or if the global regulators push back on the crypto off-ramp, or if the AI software fails to accurately process compliance checks and they have to rehire human staff, if any single gear in this massive machine slips, they will drastically miss that full-year EPS guidance.
Which brings us to the ultimate reason our listeners tune in to talk tickers. We have waded through the dismal GAAP revenue and the terrifying Q1 EPS drop.
We have.
We have unpacked the mechanical friction of the dual-track dislocation and the changing economics of global money corridors. We have deeply analyzed the incredibly complex AI and crypto-fueled Hail Mary guidance of the rest of the year.
A whole picture.
So it is time to distill all of this data into a final verdict. We need the bottom line. Where does Talk Ticker stand on ticker symbol WU right now?
Our opinionated, data-driven verdict is clear. This earnings report is a definitive, flashing red bearish signal in the short term. And it officially relegates Western Union to the ultimate show-me stock for the long term.
Show me, absolutely.
The first quarter miss was severe. Operating margins do not accidentally fall to 13%. And while the excuses provided, The vendor timing, the travel seasonality, the localized FX hit are entirely mathematically plausible. They ultimately highlight a company struggling with deep operational friction.
Yeah, too many excuses.
And the path to hitting their reaffirmed full-year guidance requires absolutely flawless, synchronized execution on incredibly complex technological and structural initiatives in a dangerously condensed time window.
Flawless.
The broader market is simply not going to give a legacy cash wire company the benefit of the doubt on unproven AI cost-cutting algorithms or highly speculative crypto off-ramp rollouts.
Yeah.
The market will demand to see the actual cash hit the bottom line before they bid the stock back up.
Exactly. The era of trusting the narrative is over. It is time to demand the data. So here is the direct, actionable advice for you, the retail investor listening right now. If you are currently holding Western Union stock in your portfolio, you need to mentally buckle up for a very bumpy ride through the summer.
Very bumpy.
Management basically admitted on this exact call that the upcoming second quarter is not going to look fundamentally better than this one. The timing issues will still drag on the numbers. You are holding a company undergoing a painful, expensive, and highly visible metamorphosis. If you believe in the long-term crypto vision, you have to be willing to endure the short-term pain.
And if you are on the outside looking in?
If you do not currently own the stock, but you are looking at the depressed share price and considering buying in because it looked like a cheap value play, keep your cash firmly locked on the sidelines.
Stay away.
Do not try to catch this falling knife. The execution risk is simply too high. Wait patiently for the Q3 earnings report in the fall. Wait to see if the promised Intermex cost synergies actually show up on the balance sheet. Wait to see if the AI headcount reductions actually lower the operational expenses.
Prove it, essentially.
Let the management team definitively prove that the grandfather clock can actually run smoothly on a blockchain engine before you commit your hard-earned capital to the experiment. Let them take the risk of the transition.
That is the most prudent data-backed move. Let management prove they can execute the dual track without completely dislocating the stock price further into the ground.
We want to leave you with one final provocative thought to mull over as you review your own portfolio allocations this week. Take a step back from the granular data and look at the massive strategic shifts we have discussed today. Western Union's biggest area of actual physical top-line revenue growth right now is running kiosks, selling physical foreign currency to British tourists going on winter vacations.
Right.
And their biggest, most heavily hyped, aggressively funded bet for the future is acting as a physical cash-out register for crypto bros trying to off-ramp their digital stablecoins.
It's wild to think about.
If the massive historical moat of the legacy cross-border remittance business, the core 170-year-old business of helping migrant workers safely send cash home to their families, is eroding so fast and becoming so structurally unprofitable against digital competitors, that Western Union has to violently pivot to these vastly different, highly complex peripheral businesses. Are you even investing in the company you think you are?
It is the most profound question an investor can ask during a turnaround. When the X-ray clearly shows that the fundamental bones of the company are rapidly mutating into something entirely different, you have to seriously ask yourself if it is still the same patient.
A brilliant way to frame it. The ticker symbol might be the same, but the machine underneath is entirely different. Keep digging into the numbers, keep questioning the corporate narrative, and we will see you on the next deep dive.